Hello everyone, this is Juan Sarmiento and today is Friday, July the 7th. Let's take a look at our current positions. I don't immediately have any candidates, so let's try and figure out what needs to be changed here. Adobe has expiration in July. Those are my short options of my Gini trade. You remember that the Gini trade has one short straddle front month and two long straddles back month. Now then you look at whether the stock, the position you have is profitable, and you see that I have here my position. Then you can just go to the monitor tab, account statement, and enter the Adobe symbol here and look back a few months, and you can see that this is the only trade. The others involved other trades, other previous trades. This is the current one, and so then I simply say analyze trade, and this will show me my trade here. Okay, this is my trade, and then you say hide positions, and you can see that this is a loser. I'm losing $1,058. Okay. Another way, you can simply say analyze the opposite. This will be what it would take to close this position, and I think I'm tempted to simply close it because it's a loser, and it is about 1 week to expiration, so I don't think it's going to change much, and so we may as well take our loss here, okay, and not prolong it. A $1,000 loss is perfectly acceptable. Think of it this way: we have our position is about 10% of my current stock, my current account cash liquid value. So we don't want to get any more than this. Will be 1% of my account. So why would I want to prolong that? So here we just take a loss and run. Okay, it's quite all right to do that and look for another trade with the cash you generate. So let's create duplicate order. To make sure that this is correct, show all, deselect the simulation of your current trade, and you should get a straight line. Okay, so here's where we take our loss. Say confirm and send, make sure that is the right account, and send. Okay, I want to take a look at the PANW right now because I got assigned. What does that mean? Well, I had two short calls and got assigned. You can simply close this position by selecting these two, the calls. Okay, you can see that I have one long call here, but if you simply roll it over to let's say 30 days from now, that's appropriate because you still have a long call here, and the two long calls that are going to be associated with the short calls that I'm about to get, I buy back my 200 shares and I sell my calls at an August expiration, and that neutralizes my trade. Okay, and you can see that the debit is less than the stock price, even though the stock price originally was 210. It's certainly more than now. This is a way to pay for that shares, but because we're paying for those shares that we got assigned, you can see it's negative, so you can't have that for too long in a IRA account without having your broker knocking at your door, okay, or giving you a call and telling you can't have this negative stock here, and this is what you would do. You can't have short stock in an IRA account. So this is what you would do: close it and sell a couple of calls against the existing calls. If I were to close that by selling the September calls, yeah, you can do that. Let's do that, all right? Forget about this position. I don't think we're going to make too much money. But then you end up with a straddle. That's what it would look like. So let's do that. Note how the debit now reduced. That's because the September option has more value. Okay, let's do it this way, okay? And once that's filled, we can sell this call at 260 and the 4 puts at 210. I don't think we'll get to 210 between now and September, so may as well cover it. Analyze closing, and it looks like a strangle, but on the put side there are four. So then we customize it. We're going to sell 4 puts, and apart from the calls, we get a credit of 2209, which is times 100 is 2,200. So yeah, let's do that and wait until that gets filled. And this way we deal with the assignment. So whenever you get assigned, you can simply close the position. There's no big loss because you get assigned. There's no big deal about it. Just close the shares and close 2 calls in order to make it a neutral trade, and then with that you sell your remaining puts and calls. You can sell the calls first and the put after that. Let's do it that way, because this might take a while to get. Why? Because the calls and the puts are very separated even from the current price. So let's cancel that. Let's do it this way. I think it's better in this situation. So let's cancel it. Okay, cancel. So sell the call first. And sell the puts second. And then you would adjust whatever needs to be adjusted so that the positions are all closed. Give me a few minutes to see if that gets filled, and let's move on to Oracle. Okay, here we are in Oracle. This is our current position. So let's say analyze the opposite, and you can see this is a loser too. Things are not working very well because the volatility has been going down. Okay, so we saw the call at 260, which is the one that was way up out of the money. So that's a good thing. Keep an eye on the others. Okay, that's the shares. Okay, so we are out of the shares. So all we have now is the puts, and there they are, all gone. And you want to see what we made or lost? Go over to the account statement and look for that PANW and look at what is year to date. Well, because we had already a profit on the other trades that we made with this particular stock, no big loss. Okay, that's good. All right, let's look at the Oracle, and I'm simply going to close that. Here's my trade. Here's my year to date. I have a profit. So if you look at the order history now, trade history, you can see that I had already made some money with Oracle, and then I entered this position, and that has not been very successful. And so analyze trade. This is my current trade. And now I want to close this. How I do that, I say analyze opposite. And you see that without my simulation here, I will indeed close the trade because it will generate this flat line. And yeah, let's take the loss as well. And then ISRG here, in this case, we have this calls expiring, short calls on July the 14th at 295. They're way out of the money. Okay, let's see what we have in on ISRG. Here is the trade. Year to date, we have money. We have made this trade. We have this is year to date. Yeah. So yeah, we have good money made here. So let's just. I don't think there's much point. There's very little time value left. So I'm going to close this. Starting with the call side. This is a calendar. If you take the first two trades, this is what it looks like. Right now it's bearish. Why? Because the cone, which is typical of a calendar spread, is below the current stock price. So we are expecting the stock to, with this trade, close down. But if it goes up, we will lose money that we already made. So I'm going to close this. Analyze closing. And that closes the calls. And let's confirm and send. All right. Then we have the put. The put is a loan, and there's a call also at a higher strike price. We are going to close that too. And we are going to close this put, 4 puts. You see what do I have? Yeah, so we need to close the put. That's the ISRG. Let's close the put. Okay, just select the put here just to make sure that you're closing it. Yes, indeed. Confirm and send. And always check that the closing is going to create a flat line. That's, you're not making any mistake. I used to make many mistakes in entering my trades once in a while, really. You would enter the wrong order. Well, by showing your trade like this one here, okay, that's a cover call. So when I'm sorry, that's a calendar spread, and this is the calendar. So when I say analyze trade, it takes my current order and it would generate a flat line. So you want to see that flat line in order to close the trade. Okay, I really don't have a trade, but I'm going to review what candidates we have in the past, and go quickly through them and see if there is anything that interests me. For example, LRCX has earnings coming up, so we don't want to do that. LEN, they just had earnings, and the volatility is, this could be possibly a trade here. They beat expectations by a wide margin. Yes, they did. No? Yes, they did. So this is a potential trade. Okay, FedEx, they reported earnings and the volatility is down here. That could be also a trade. So we eliminate the LRCX. CRM, also very low volatility right here, but you can see that the line is yellow. We will confirm that. Is a stock that has gone sideways. They reported earnings that beat expectation by a wide margin, so it should have, but it had already had a big. So yeah, that's another potential trade. Let's look at AVGO. AVGO, they reported earnings. The stock really went up, but then went sideways. The volatility is declining now. Okay. Any of these 4 trades could be good. So let's go to alphabetically. Okay. Would I trade this? Well, let's go to the Analyze tab, and here is a potential trade. Okay, so you can see that I have 2 long straddles back month, 1 short straddle for front month. Make sure that the expiration is about 30 days from now for the short. Okay, we can do either August the 4th or August the 11th. Let's do August the 11th first. Look at the volatility. Is the volatility okay? Well, it seemed like make sure that the strike price, will be, yeah, we can reduce it to 850. It needs to be, the strike price needs to be very close to the current stock price. So I'm gonna do it 850 is the closest. And then I noticed that the longs are not available. Okay, so that's the reason why that 860 was what I had in my previous trade. So okay, let's do it at 860. Okay, now we're going to use this. You can see it in the bottom right corner. Those are the volatilities of each one of your legs. The volatility of the back month is of the options we're buying. Well, the higher this number is, the more expensive that option is. So yeah, I can see that there is quite a variation there. So let's do a calculator. Let's use the calculator here. So let's show the paper so you can see my calculations. Okay, so I'm going to take the options back month 33.29. Please focus here on the implied volatility of the options at the bottom, okay, right here, and plus 26.41, and divide that by 2, and you can store it, clear memory and store it. Okay, that's the average volatility of the options we are buying. The options I'm selling is 24.35 plus 29.60 divided by 2. Okay, 26.9. You see the difference? Okay, let's subtract it from memory, this number, and then recall, and you can see that it's less than 3%. That to me is acceptable. If this is 3% volatility, that's fine. The averages of the options we're buying versus the ones we are. Okay, so this is our trade looks like this. Okay, great. We already said they beat by a wide margin. Over here, the earnings came at 10.32. And of course the price is going to be too much. I just realized. Okay, so you can see it says 161.95. That's really times 100 is 16,000, and we can't trade any more than 9,600 in any single trade. So let's go straight to FedEx. Okay, so we didn't waste our time. We're just learning. Okay, and here you are, 29, 22. Yeah, that looks. The volatility here of the short is way too low for the puts. What is the strike price? 250. The volatility, August 11. The volatility may be the problem, let's say. So, okay, let's do this as well. So, just for the exercise, I'm not really sure if this is going to work. 29.63 plus 22.58. Obviously, that's the volatility of the options we're buying. So divide that by 2. Clear memory and store it. Okay, 26. And I can see that that's going to be, let's see, 25.12 plus 19.92 divided by 2, 22. Okay, so subtract it from memory, and then memory recall. It's more than 3%. It's too much variation, so we don't want to trade that. I think that's a killer for that trade. Let's look at LEN. I think we've done this last week, but I'm doing it again. Okay, the strike price should be 120. 31, 23, 26, 23. And this is probably not good enough. Clear memory. And we have 31.96 plus 23.76 divided by 2. And let's store that in memory. And then the other is 26 plus, this is the volatility of the options I'm selling. Ideally they should be bigger volatility, but it rarely is. It usually is about 3%. If that's the case, we can trade. So let's subtract from memory, and then memory recall, that's less than 3%. This is acceptable, all right? Let's see other items that we need to look at. Earnings beat expectation by a wide margin. Yes, it did. Okay, the stock has been in a rally. It's pulling back a little bit. The volatility, you see the little chart here is green, which means that the implied volatility is in line with the historical volatility, and it's at the bottom of my chart. So yeah, great. What about how liquid this is? We would know how liquid these options are when we create duplicate order, and then you see mid versus natural down here. Again, use the calculator. Clear the memory. 25.65 plus 26.45 and divide that by 2. What? I'm sorry. We need to take the bigger number, 26.45 minus 25.68, then divided by the larger number, 26.45. And that gives me something wrong here. The difference is very small, 26.35 plus 25.58. No, I'm supposed to subtract. Sorry for the waste of time here. There we go. Okay, so 0.52, divide that by 26.35, and that gives me a percent of times 100, 1.9. So it's less than 3%. This is liquid enough for us to trade. Fantastic. This usually is the case. It's very rarely you have options that are from stocks that nobody trades or are very thinly traded that this will be a problem. Okay, you can also go to the trade tab. That's the last calculation we're going to find here, and look for, scroll down, this is Len again, and you can see that the current IV percentile is 10%. That means less than 15. It just means that the volatility is down here at the lowest quarter of my year chart of the IVSV. Okay, that sounds like a great opportunity, a great trade. Now we create duplicate order, confirm and send. Before we send, we say multiple accounts, because now we want to see that is this IRA entering 15. Yeah, that's the correct account. And how much money am I going to spend on this? $2,500. And I can spend as much as $9,600. So I'm going to do 2, 3, 4 is too much, 3 is okay. I'm going to spend $7,689. Send that off and wait until it gets filled. And finally, I do CRM. And again, we have this trade from last week. The strike price is about the same. I'm going to unlock and do the evaluation of the options as well. Okay, let's clear this and clear this as well. Again, we're going to take the volatility of the options here, 33.93 plus 26.29, divide that by 2, clear my memory and store it. Okay. Obviously this is going to be too much. 28.88 plus 24.72 divided by 2, 26. We subtract from memory, and then memory recall gives me 3.31. Yeah, it's borderline. I want this to be 3. Okay. All right, so let's go to the chart. And you can see volatility as at the lower quarter. The stock has been going flat for a while. It's almost like it wants to move somewhere. I would think so, yeah. Either strongly up or strongly down. I'm very tempted. The earnings came way ahead of expectations. So I would expect a strong move up. But you never know. There might be other reasons why the stock will drop. And the news may come up. Okay, so I'm going to do it anyway. Okay, I understand that it's not quite 3%. Let's see how liquid it is. Create duplicate order. And yeah, that's probably liquid enough. So in this case, the natural is 47.5 and minus the mid, which is 46.98, difference 0.52, divide that by 47.6 times 100 is 1 point, so it's liquid enough, no problem there. Great. All right, so what is the other factor? Let's go to the trade tab and scroll down, and we see that the current IV percentile is 9%. That doesn't surprise me. The chart shows it here, that it's very low. Okay, so that's another way of looking at it under the trade tab. And 9% is acceptable, 15 or more is less acceptable. So I'm going to trade it anyway. I understand that the volatility is a little against me, but it looks otherwise very good. Okay, so in this case, I can do probably 2 of these trades. Create duplicate order, confirm and send, multiple accounts. And here is my 15 ending, account ending in 15. If I do 2 of them, perfect. 9,406. That's 10% of my account. And I'm going to send it. Okay. And that's about it for today, I think. I will simply make sure that all these trades are filled. For example, this Oracle needs to come down quite a bit. So I create, cancel, replace, unlock it, and try to sell at 1561. Otherwise, I keep adjusting my trade until they all get done at a reasonable price. In this one, well, between mid and natural is quite different, so I'm gonna have to drop it. And I drop it by 5-cent increments. And my longs here, I think, you see the debit is a little, yeah, we're going to adjust the debit. So I simply unlock it. Let's add 3 more, 3 cents, 4 cents, let's say 5 cents. Okay, so these things I'm going to do until each trade gets filled. And we got the CRM filled. Excellent. The LEN here is very, very close, but it's below the debit. So unlock it and just increase a couple. Excellent. Okay, so I'm going to change this until they all get filled. and these two numbers will get closer together as I move in. Okay, so that's all for today. Thank you very much for joining me, and see you next time. Bye bye.